I have built 3 financial models. We have to bring those cash flows to present value using a discount rate, which in this case is 11.5%, and the intrinsic value per share of NSDL is. Before coming to the valuation, first, we should look at the company business model. NSDL is a registered market infrastructure institution playing a pivotal role in India's financial ecosystem. It provides a broad suite of services to the capital markets, including depository, custody, and settlement solutions. As the largest depository in the country, NSDL boasts the highest number of issuers and active financial instruments. It also leads in dematerialized settlement volumes and total assets under custody, key indicators of its scale and trust in the market. What's especially remarkable is its extensive reach. Company operates through nearly 65,400 depository participant service centers across the country, a vast network that far surpasses its nearest competitor, CDSL, which has close to 19,000 such centers. Behind this leadership lies a strong foundation of technology. NSDL infrastructure is built on secure and adaptable tech systems designed to cater to the needs of investors, brokers, and issuers alike. The focus isn't just on speed, it's about efficiency, security, and cost reduction, all while minimizing operational risks. To simplify a few terms, a depository is essentially like a bank, but for securities instead of money. A demat account allows investors to hold shares in electronic form, eliminating the risks and hassles of physical share certificates. Custody refers to the safekeeping of these securities, and settlement is the actual transfer of securities after a trade. By enabling all of this digitally and at scale, NSDL forms the backbone of smooth, reliable capital market operations in India. NSDL plays a crucial role in India's financial market by offering end-to-end electronic solutions for securities ownership and transaction management. One of its core functions is maintaining electronic book entry records for security allotments and ownership transfers. In simple terms, this means that instead of dealing with paper certificates, everything from issuing shares to recording who owns them is done digitally. This not only enhances transparency and efficiency, but also significantly cuts down the risks and costs associated with manual processes. Company's advanced technology supports every link in the financial chain, issuers, investors, and intermediaries, ensuring that transactions are smooth and secure. Beyond just record keeping, company also excels in asset servicing. It safeguards a wide variety of dematerialized assets, from equity shares to bonds, using highly resilient software infrastructure. This ensures business continuity even during unexpected events and allows for effective and secure management of these financial assets. In its depository and transaction services, company handles everything from the initial dematerialization of physical securities to trade settlements. It also enables off-market transfers. These are transactions that happen outside of stock exchanges, such as gifting or private transfers. NSDL further facilitates pledging and repledging of securities, which is when investors offer their holdings as collateral to get loans or margins. It even supports specialized accounts like Client Unpaid Securities Pledge Accounts, CUSPA, which help brokers and clients manage unpaid securities in a transparent, compliant manner. Through these services, company provides a robust infrastructure that powers the safe, seamless movement of securities across India's capital markets. The company extends its impact beyond traditional depository functions through its specialized subsidiaries that offer cutting-edge tech and financial services. One such arm is NDML, or NSDL Database Management Limited, which focuses on a range of e-governance and regulatory solutions. From automating special economic zones to managing the National Skills Registry, NDML supports various government initiatives aimed at improving digital infrastructure. It also provides KYC services, operates an insurance repository, and develops platforms that help regulators and institutions ensure compliance and transparency. Another key subsidiary is NSDL Payments Bank Limited. NPBL operates on a B2B digital banking model with a strong focus on financial inclusion. It is designed to reach underserved and remote populations that are often excluded from the traditional banking system. The bank provides essential services like domestic money transfers, savings accounts, Aadhaar-enabled payment services, and micro ATMs that function like mini-bank branches in rural areas. Additionally, NPBL offers prepaid cards (UPI) services to facilitate seamless digital transactions. It also acts as a distribution channel for life and health insurance products, as well as mutual funds, bringing a full suite of financial tools to the last mile. Through these subsidiaries, the company is not only strengthening capital markets but also building the digital and financial backbone of the nation. The company stands tall as India's first and largest depository, firmly anchored in a technology-first approach to transforming capital market infrastructure. As of March 31, 2025, it continues to lead the industry by several key metrics, including the highest number of registered issuers, active financial instruments, DEMAT settlement volumes, and the total value of assets held in custody. With over 3.95 crore active DEMAT accounts spread across the country, the company serves as the backbone for millions of investors, brokers, and market participants. At the heart of this leadership is a relentless drive for innovation. The company has consistently pioneered new digital solutions to simplify and secure financial operations. It was the first Indian depository to offer instant SMS alerts to investors, empowering them with real-time updates and greater control over their investments. It also introduced a specialized tax service that streamlines documentation for dividend payments, removing paperwork hurdles for investors and issuers alike. In 2021, the company launched a digital platform for issuing commercial papers, bringing more efficiency and transparency to short-term corporate debt markets. Additionally, its centralized data processing framework acts as a powerful repository, housing diverse datasets that support analytics, compliance, and strategic decision-making across the financial ecosystem. This strong focus on technology ensures the company remains not just a market leader, but a forward-thinking enabler of India's growing financial landscape. The company's business model is built on a stable and recurring revenue structure, which ensures a strong foundation for long-term growth. Unlike revenues that depend heavily on daily trading volumes, a significant portion of the company's income comes from annual custody and maintenance fees. These fees are charged for holding securities in DEMAT form and maintaining investor accounts, making the revenue stream steady and less vulnerable to market volatility. This predictable cash flow allows the company to continue investing in advanced technologies, improve its service offerings, and maintain operational excellence throughout its vast ecosystem. Additionally, beyond core depository services, the company earns recurring income from a range of value-added solutions, further diversifying its revenue base and reinforcing financial resilience. The company's strength is also evident in its leadership across diversified asset classes. It doesn't just hold equity shares, but a wide spectrum of securities in electronic format, giving it a strategic edge in India's evolving financial landscape. As of March 31, 2025, the company held more than 85% of all securities in the country by number and nearly 87% by value, an overwhelming majority that reflects its trust, scale, and reliability. This wide coverage across asset types solidifies its position as the backbone of India's depository infrastructure. The company has outlined a forward-looking strategy focused on expanding its market presence and deepening its role in India's financial ecosystem. A major priority is to grow its reach by tapping into both high-potential urban regions and underpenetrated rural markets. By making its suite of products more accessible to a broader investor base, the company aims to further solidify its dominant position in the depository space. One of its key goals is to simplify and scale mutual fund investments through dematerialization, bringing the same efficiency and transparency to mutual funds that investors have come to expect in equities. At the same time, it's actively exploring enhancements to its digital platforms for services like e-voting and EAGMs, helping issuers and shareholders engage more seamlessly. Central to its strategy is continuous investment in IT infrastructure. As transaction volumes rise and user expectations evolve, the company is upgrading its entire tech stack to ensure scalability, speed, and resilience. It is transforming back-end applications to deliver a more efficient and robust experience, while also embracing a mobile-first approach in services where convenience is key. Digitizing operations further supports this push by enabling self-service journeys, allowing users to perform key tasks on their own, quickly, securely, and without intermediaries. Another pillar of the strategy is scaling its payments bank business, operated under NPBL. The company is steadily expanding this vertical to increase its market share and drive financial inclusion across the country. By reaching deeper into underserved segments and offering essential banking and financial services through digital and assisted models, the company is positioning its payments bank arm as a key enabler of grassroots-level financial empowerment. The company operates in a competitive but highly regulated space, holding the distinction of being one of only 2 securities depositories in India, alongside its direct rival, CDSL. This duopoly defines the core depository market, where both entities compete on parameters such as number of active demat accounts, issuers, instruments, and service innovation. Despite the limited number of players, the competition is intense, driving constant improvements in technology, service delivery, and product offerings. Its subsidiary, NSDL Payments Bank, functions in a much broader and more crowded arena. Here, it competes with other major payments banks such as Fino, Paytm, Airtel, Jio, and India Post. The battlefield spans across customer acquisition, seamless tech integration, service quality, and user support. On top of that, NPBL faces additional pressure from fintech companies, microfinance institutions, small finance banks, non-banking financial companies, scheduled commercial banks, and even foreign banks, each bringing its own set of digital strategies and outreach capabilities. NDML, the tech and e-governance arm of the company, also navigates competitive terrain across multiple regulated sectors. In the insurance repository space, it competes with other entities approved Insurance Regulatory and Development Authority of India. Similarly, in payment aggregation, it goes head-to-head with RBI-registered payment aggregators. Despite this wide-ranging competition, the company leverages its strong brand trust, regulatory compliance, and tech-driven efficiency to maintain a solid standing across all its verticals. The company is set to hit the public markets with an IPO size of Rupee 4,011 crore, offering shares in a price band of 760 to Rupee 800 per share. The public issue opens on July 30 and will close on August 1, giving investors a 3-day window to subscribe. The tentative allotment of shares is expected on August 4, followed by the initiation of refunds for unallotted applicants on August 5, the same day when the allotted shares will be credited to investors' demat accounts. Finally, the company is likely to make its debut on the stock exchanges on August 6, 2025. Now we've come to the most important part, the intrinsic valuation of the company. To capture a full range of outcomes, I've built the model using 3 scenarios. First, let's break down the conservative valuation of the company using the discounted cash flow method. This is a forward-looking approach where we project the company's future financials and bring those cash flows to present value using a discount rate, which in this case is 11.5%, representing the company's cost of capital. I have assumed a compound annual revenue growth of 14%, a healthy but conservative estimate given the company's dominance and long-term potential. Revenues are projected to grow from approximately 1,750 crore in year 1 to nearly 5,950 crore in the terminal year. This captures a steady expansion as digital finance deepens its roots across India. From revenues, we subtract the cost of goods sold, which represents the direct costs associated with delivering depository and digital financial services. COGS increases with revenue, starting at around 1,190 crore and reaching just over 4,280 crore in the final year. This results in a gradual compression in the company's EBITDA margin, from around 32% today to about 28% in the later years, reflecting a conservative assumption that margins will come under pressure due to increasing competition and infrastructure costs. Next, we subtract depreciation, a non-cash expense that accounts for the wear and tear of technology infrastructure and systems over time. This line steadily grows from about 39 crore to 112 crore, tracking the company's ongoing investments in software, data centers, and platforms. Once we deduct both COGS and depreciation from revenues, we get to EBIT, earnings before interest and taxes. This is essentially the company's core operating profit before financing costs. EBIT rises steadily from about 520 crore in year 1 to over 1,550 crore by the terminal year, showing the company's capacity to scale profitably, even with margin pressure. Now we apply taxes. So EBIT is multiplied by the tax rate to arrive at EBIT after tax. This is the company's true operating profit after tax, without the effect of financing or non-core activities. It starts at around 385 crore and climbs up to 1,150 crore, indicating strong underlying profitability. To get to free cash flow to firm, we add back depreciation, since it's a non-cash charge, and then subtract two important components: capital expenditure and changes in working capital. Capital spending refers to the money the company reinvests into upgrading or expanding its infrastructure. It's modest and efficient, ranging between 89 crore to about 143 crore, reflecting disciplined reinvestment. Then we adjust for working capital, which captures changes in short-term assets and liabilities. This can vary depending on the company's business cycle. For example, a positive number here indicates cash being tied up in operations, while a negative number indicates cash being released. In our model, working capital swings moderately, sometimes requiring cash, sometimes freeing it up, with the biggest outflows seen in years where revenue scales up quickly. After putting all these pieces together, we get free cash flow to the firm, arguably the most important figure in this model. It represents the actual cash the business generates that can be used to reinvest, pay down debt, or reward shareholders. In this case, it grows from around 230 crore in year 1 to over 1,170 crore by the terminal year, an impressive trajectory that reflects consistent financial strength. But we don't stop there. Each year's cash flow is discounted back to present value using our 11.5% cost of capital. This accounts for the time value of money, recognizing that a rupee earned 10 years from now is worth less than a rupee today. The present value of cash flows ranges from around 200 crore in the early years to over 430 crore closer to the end, before factoring in the terminal value. Now that we've projected the company's cash flows, let's arrive at its total valuation using the DCF method. First, we calculate the present value of all future free cash flows during the high growth phase, which comes out to approximately 3,300 crore. This represents the discounted value of the company's operations over the next 10 years, based on our conservative assumptions. Next, we estimate the terminal value, which captures the value of all cash flows beyond the 10th year into perpetuity. This is a crucial part of the DCF because businesses like this don't just operate for a decade, they continue generating cash flows long into the future. After discounting the terminal value back to today, we arrive at a present value of around 8,310 crore. By adding the high growth phase and terminal value together, we arrive at the total value of the firm, which is approximately 11,610 crore. Now, to determine the equity value, we subtract the market value of debt, which is assumed to be around 700 crore. This gives us an equity value of 10,910 crore. But that's not all. We also add back the cash and cash equivalents held by the company, which amounts to 145 crore. Why? Because this cash is not tied up in operations and is available to equity shareholders. So when we add it, the total equity value in common stock rises to roughly 11,056 crore. Now for the most important figure, the intrinsic value per share. Based on 20 crore outstanding shares, the value per share comes to rupee 553. This means, based on a conservative DCF with realistic growth assumptions, margin compression, and a cost of capital of 11.5%, the fair intrinsic value per share is estimated to be around Rupee 553. This is the base case scenario of the discounted cash flow model. In this, I have assumed the company's revenues will grow at a compounded annual rate of approximately 19% over the 10-year forecast period. Starting from just over 1,827 crore in year 1, revenues steadily climb to about 8,741 crore by year 10, before reaching 9,130 crore in the terminal year. This robust growth reflects a strong market position and expanding operations. The cost of goods sold increases in tandem with revenues from about 1,242 crore in year 1 to nearly 6,000 crore in year 10, maintaining a relatively stable gross margin. Depreciation begins at around 39 crore in year 1 and gradually rises to 117 crore by year 10, indicating steady capital investments and a growing asset base. Earnings before interest and taxes show healthy growth, climbing from 546 to over 2,600 crore by year 10. After accounting for taxes at a consistent rate, net operating profit after taxes increases from 404 to around 1,960 crore, highlighting efficient operational scaling. Adding back non-cash depreciation each year enhances the cash flow, while capital expenditures, starting at 89 crore and peaking around 165 crore, reflect the company's ongoing investments in future growth. Changes in working capital vary significantly, with some years showing positive inflows and others reflecting outflows, emphasizing operational expansion and inventory adjustments. The resulting free cash flow to the firm is a critical measure in this DCF. It starts modestly at 208 in year 1 but grows sharply to over 2,200 crore by year 10, showcasing the firm's increasing ability to generate value. By the terminal year, FCFF stands at roughly 2,120 crore. To bring future cash flows to present value, I have used a discount rate, reflecting the company's weighted average cost of capital of 11.5%. This rate balances the time value of money and investment risk. When we discount each year's free cash flow, we find a present value starting from 186 crore in year 1 and rising to 789 crore by year 10. Based on the DCF analysis, the present value of free cash flows during the high-growth phase, from year 1 to year 10, is approximately 4,580 crore. This represents the company's strong performance, fueled by solid revenue growth and improving operational efficiency. The terminal value, which reflects the company's worth beyond year 10, contributes a substantial 14,980 crore in present value. Combined, these bring the total value of the firm to around 19,560 crore. After subtracting the market value of debt at 700 crore, the market value of equity comes to 18,860 crore. Adding back cash and cash equivalents of 145 crore, the total equity value stands at 19,010 crore. With 20 crore shares outstanding, the value per share is approximately 950 rupee. Now let's dive into the optimistic DCF valuation of a company. I've assumed that revenues will grow at a 25% compounded annual growth rate over the next 10 years, while EBITDA margins are expected to improve steadily from 32% in year 1 to 36% by year 10. Starting with revenues, the company is projected to grow from around 1,919 crores in year 1 to 14,295 crores by year 10, finally reaching 14,939 crores in the terminal year. That's a strong and consistent top-line growth story, aligned with the 25% CAGR assumption. Next, we deduct the cost of goods sold, which begins at 1,305 crores and increases to about 9,321 crores by year 10 and 9,561 crores in the terminal year. Then we subtract depreciation, which starts at 39 crores in year 1 and rises gradually to 129 crores by year 10 and 135 crores in the terminal year. This brings us to EBIT, or earnings before interest and taxes, which grows from 575 crores in year 1 to 4,846 crores in year 10 and 5,243 crores in the terminal year. After applying taxes, the after-tax EBIT increases from 426 crores to 3,586 crores by year 10 and to 3,880 crores in the terminal year. We then add back depreciation, since it's a non-cash expense that boosts free cash flow. Next, we deduct capital spending, which varies between 89 crores and 216 crores across the forecast period. We also account for changes in working capital. Once we put all that together, we get the free cash flow to the firm. This starts at 184 crores in year 1 and grows impressively to 4,213 crores by year 10. Finally, we discount all these future cash flows back to the present to calculate their present value. The present value starts at 165 crores in year 1 and grows to 1,491 crores by year 10. The present value of cash flows during the high growth phase comes out to about 6,797 crores. The present value of the terminal value, which represents the bulk of the firm's long-term worth, is around 28,008 crores. That gives us a total firm value of approximately 34,805 crores. From this, we subtract the market value of debt, which is 700 crores, to arrive at a market value of equity of 34,105 crores. Adding in 145 crores of cash, we get a total equity value of 34,250 crores. With 20 crore shares outstanding, the intrinsic value per share comes to 1,712 rupees. So, based on this optimistic case, the stock is potentially worth rupee 1,712 per share, suggesting strong upside if the company delivers on this growth trajectory. This video is intended for educational purposes only and should not be construed as investment advice. The analysis presented, including conservative, base, and optimistic DCF scenarios, is based on certain assumptions and forward-looking estimates. I am not a Securities and Exchange Board of India registered investment advisor, and the views shared in this video are purely for education purpose. Please consult your financial advisor before making any investment decisions.